Public.com presents Leading Indicator, an investing show bringing you insights from the sharpest leaders in business, finance, and technology. With us today to talk about a possible stock market bubble is Jason Shapiro, founder of crowdedmarketreport.com. Jason, thanks so much for joining us on what is a Fed reflection day. So it's a big one for the markets.
Thanks for having me.
So Jason, let's start with what seems to be the rising tide at the moment for the entire market, and that is Nvidia, up more than 80% year to date, now worth north of $2.2 trillion as AI enthusiasm, and I pick that word deliberately, continues to lift the market. So Jason, is this enthusiasm around AI and with it Nvidia hype, appropriate enthusiasm, positivity that you think is well worth it? What's your view?
You know, I'm 56 years old. I'm lucky if I can spell AI.
No.
You know, this is not my thing.
Okay.
What AI is, what AI is going to become, what the future looks like. I can tell you, if there aren't better people to tell you the answers to that than me, then we're all in a lot of trouble. You can make the argument clearly that, hey, AI is going to be the greatest thing that ever happened for productivity in the history of mankind. Okay. And maybe it is. Okay. What's important to me is the market certainly treats it as if it's going to be at this point. And as a trader, you might as well believe that at this point, because anything else is losing you money. It's been fascinating to watch the NVIDIA situation over the last 10 months. And I had made a few videos on YouTube about this very thing. I have seen many, many, many more people try and short this thing the whole way up than I have seen people try and buy it. Okay. So as a trader, and in particular, a trader that likes to watch for participation in what people are doing so that I can go opposite that. That's been the most interesting story for me as a trader in NVIDIA, is how many people want to short it. The fascination with trying to pick the top in NVIDIA has been really unbelievable.
So Jason, if AI isn't your thing, I don't believe that you can't spell it, because I know you can. You can even, I think, spell artificial intelligence. I'm going to take it a little broader.
Maybe.
What is your thing? When you look at the sectors right now, which ones are in your wheelhouse where you say, okay, this is an interesting point in the market for those?
I mean, most people don't trade this type of stuff, but we're pretty interested in grains here. One trade I have on here is short cotton. Just as an aside, you know, I trade a very specific process. So when my process hits, I put a trade on. That don't always work, but hopefully over time give me better reward than risk over time. As far as the stock market goes, which I think is probably what most people are interested in, we closed at all-time highs yesterday on the S&P 500. I don't really know that anything else needs to be said other than that. You know what I mean? Are you going to try and just short all-time highs? You know, what's the purpose, right? What's the purpose of shorting an all-time high? I think it's just, no matter what asset it is, it's the dumbest thing that you can do. You know, what are you going to miss? Like, you really feel like you're going to short an all-time high because you're going to wake up tomorrow and the S&Ps are going to gap down 200 points and you're going to have missed the big sale? It doesn't happen that way. I've traded, I don't know how many markets, dozens and dozens of markets for many, many years. I am a turn picker. Okay. So I am looking to sell tops and buy bottoms. But that's not what turns look like. They don't close on an all-time high and then gap down 20% the next day. You can go through any crash you want. 87 crash, the market topped a month before the 87 crash. So you had a month before you really had to short it if you wanted to catch the top. 2008, the market topped really in 2007 at some point before it ultimately did the 2008 crash, right? So you had plenty of time to catch the crash, right? So this habit that people have, and I've been there. When I was a younger trader, I went through all this. I know what it's about, right? This need to feel like you can't miss the top is extremely dangerous. And that's what a lot of people are doing here. I mean, the S&P closed at an all-time high yesterday. That's really all you need to know. We can sit here and talk fundamentals and overvalued and this and that and the other thing, but the tape tells you what you need to know. And when a market closes on an all-time high, there's just no reason to try and short it. Tomorrow. You can short it tomorrow. You can short it today. Let the Fed come out and say something bullish, right? And then let the market go down on that bullish news. And then you can try to short it, right? But to just keep shorting all-time highs, be it NVIDIA, be it the S&P 500, whatever it is, be it cocoa, I don't care what it is. It's just bad. It's a horrible, horrible idea. It's the road to the poorhouse.
So I do want to talk about sectors and fundamentals and come back to those, because you've seen a lot of cycles, you've traded a lot of markets, as you said. I want to come back to some trends. But before we do that, here's a question I want to get to with you, Jason. If you look at the S&P 500, as you just said, all-time highs, that index is up 31% and change over the past year. NVIDIA about 5% of the overall index. You've made the point, which I think is a really interesting one, which is trying to call the exact top maybe a fool's errand. But as you look at this valuation set now, as you look at the momentum now, as you look at the indicators that you have found pattern recognition over the decades you've been trading, the all-time high that we just hit, is your gut that this is top of the market? Whether people should or not, do you think there's more to run?
Yes, I do.
You do. And how much more do you think there is to run?
I don't know. I have no way of knowing. And even within me thinking that if my indicators come out and say short, then I will short it. They're not going to happen this week, but could happen next week for all I know. If my indicators say short, I'll short. But
what are your indicators, Jason? Give us a flavor for some of those.
So I look to short markets that are hugely crowded long. So I use the commitment of traders data in the futures market to tell me where stuff is crowded. That's one place where I get to where stuff is crowded. So that has to be super crowded in order for me to get short. And it's not super crowded now. It's amazing that it's not super crowded, but it's not, because truthfully, the last month and a half, we have seen people selling into this rally. So they've gotten less long. Usually we'll have a trend going up and people will be buying into the rally and getting longer and longer and longer. In this case, we've been watching people get less long the whole way up. So you can't tell me that that's a crowded market. And you need to go no further than me, or no further than you. Ask yourself, whoever's out there listening to this, right? Are you 100% fully invested in the stock market here? I can tell you I'm not. Okay, I wish I was, but I'm not. I sat with my son this past weekend, who's 26 years old, and he's got the 401k rolling from his job. And he told me he sold half of his longs in the stock market in the 401k, last year, because he thought the market was going to crash, and he hasn't gotten it back in. And I think that that's no different than anybody that I know. I speak to my wealth manager, for example, who has a lot of people and a lot of assets under management. He said it's one of the lowest allocations to equities that his client base has ever had. And that's not because of him, it's because of them over the past year and a half saying, take me out of the stock market, right? That traditionally is not what an ultimate top looks like, Now, maybe it's a little bit different this time, because maybe that money's never going back in. Maybe they're just happy sitting there with their 4 or 5% yield, risk-free yield, so to speak, and they're never going to chase it. Maybe that's the case. But traditionally, that is not what an ultimate top looks like in the stock market. So I don't think that, for me at least, this is not an ultimate top.
And Jason, when you break down the different sectors, to go back to sectors and fundamentals, are there any subsectors of the market that do look more crowded than others right now?
I think that there's been a big idea from people. They've switched. Look, everybody was bearish last year. They can no longer be super bearish because the market's running away from them and they're underperforming the market. They have to put money to work, right? So what I have heard a lot of is they are doing what a lot of people do wrongly. They are buying the laggards, right? In other words, they are cutting their roses and they are watering their weeds, right? So they're getting out of the stuff that's making them money and they're putting into the laggards. And what they see as the laggards are small cap stocks, emerging markets, and oil is a big one I hear a lot too. And that doesn't mean those can't go up. They have in the last few weeks had a good run. The oil stocks have had a great run the last few weeks. But I think that's because all these people are putting their money into that. And when that runs out, I think there's going to be a problem. So those are the sectors that I think are probably going to be the underperformers very soon, including today. But oil, small caps, emerging market, I think are going to be the underperformers over the course of the year, be it the market goes up or down.
Okay, so I want to go back to the advantage that you have of having invested in these in markets for such a long time. You've been through cycles, you've been through patterns, and you've talked about how this doesn't look like it's the top in terms of there not being overcrowded from a long perspective. But let's go back to fundamentals. You've lived through cycles before. At the valuations we're seeing right now, so forget whether the cash is going to come in or not from the sidelines, but just the valuations that we're seeing at the moment. How does this feel to you? Is your gut or your pattern spotting telling you this is frothy or bubbly? Or do you think valuations are looking at a new step function based on the excitement around productivity gains that could come?
Yeah, I mean, you have to tell me how real those productivity gains are before you can really tell me what valuations are, right? And I don't think, this is the fun part about the market. There is no way to know the first one, so there is no way to know the second one. It's very easy to look at, PE is compared to history or this, and therefore it's over or undervalued. That's never worked for anybody, right? Because we don't know the future. If these productivity gains supposedly are going to be huge, then the market obviously is very cheap. And if these productivity gains are a bunch of hogwash, then the market probably isn't very cheap, right? And I wish I knew the answer to that, but I don't think anybody knows the answer to that until we get there. So it's a question of what has the market discounted in, right? How do we judge that? I judge that by positioning, right? A lot of people judge that by price. They say, hey, this thing has gone up a lot, therefore it's discounted in. I don't look at it that way. I look at it like everybody has gotten super long here, therefore the market has discounted it in. That's what I see as the discounting mechanism, positioning, not price. In particular, as a contrarian, people that try to be contrarian price die, okay? So I'm not contrarian price. I'm contrarian positioning. So, and we can see that. Listen, if anybody wants to see it, look at the cocoa market. All right. People have been telling me now for about a year that I wouldn't say a year. I would say 8-9 months that the cocoa market is ridiculous. Okay. That it's overvalued, that it's gone up too much. That's the one I hate the most. It's gone up too much. The price is ridiculous. Well, I've been hearing that since about 3,500 in cocoa. Today, cocoa is trading 8,400. Okay. And I heard it at 3,500. I heard it at 4,500. I heard it at 5,500. I heard it at 6,500. And I'm still hearing it at 8,500. Okay. If you're going to use price to determine where value is, and what's overdone, there's a very good chance you're going to get run over time.
So Jason, let's shift gears a little bit and talk about what could change sentiment, right? You've talked about one specific area, cocoa, where you've been consistently, I think, trying to crowd out sentiment and just sort of focus on your indicators. What the Fed is going to do has been a part of some of the volatility that we've seen in the market, right? Get the trend. It's the actual sort of the motion, the roller coaster we've seen. The Fed's March meeting, as I started top of the show, officially kicked off today. Estimates calling for a 99% chance of holding rates steady, and that's according to the CME FedWatch tool. And it feels as though sentiment has actually extended the runway of patience that the Fed is anticipated to have to fewer rate cuts for 2024 than certainly folks would have expected at the end of 2023. What do you think the Fed's going to do?
What do I think the Fed's going to do, or what do I think the Fed should do?
What do you think they're going to do? Because ultimately that's what matters, right? It's what the Fed does that's going to make the move.
Yeah, I don't think they're going to do anything today.
Sure, yep.
My opinion, as an amateur economist at best, for a while now, for a few months now, has been, I don't get how they're cutting rates. I understand people are talking about it and they keep talking about it, but I don't get it. What if you had gone to sleep 5 years ago and woke up today and looked at the last 6 months of economic data, GDP, CPI, employment report, you would just be saying, well, when is the next Fed rate rise and how much is it going to be? That would be the only question you'd be asking. So why is it that everybody thinks that the Fed's cutting? And I'm not saying that they're not going to. We get data coming up and it could be weaker and maybe that will show, right? But as of today, whatever day today is, the 20th of March, why are they even talking? Why are people even talking about cutting? It makes no sense to me whatsoever. We have gold at pretty close to all-time highs, right? We have stocks around the world. It's not just the S&P 500, right? The Nikkei, the DAX, the Euro stuff at all-time highs. So clearly there's liquidity out there. I mean, you go out, right? Restaurants full, airports full, airplanes full, right? So whether you want to argue with it or not, there is clearly a lot of money out there and a lot of liquidity. So if they're going to cut rates, that to me is the most insane thing there is. So what I've been thinking as a way to not short the stock market is that I feel like there's a chance the market is going to force the Fed's hands. People say a lot, the market's going to force the Fed's hands, and they usually mean it in terms of something's going to go wrong. The banks are going to blow up because of the commercial real estate thing, and it's going to force the Fed's hands to cut rates. I think it could be the opposite. I think the market could keep going up, and it's going to force the Fed's hand to raise rates, right? I mean, if we get to June, they're not going to cut today, but we get to June and gold is at 3,000 and the S&P is at 6,000 or something, right? You're telling me that they're going to cut rates into that? That would be the most insane thing in the world, right? So that's what I believe. I personally believe that there's a good possibility that the next move is up. And I think the markets are going to force it to be up. Whether that's right or wrong, listen, I have no way of knowing the future, okay? But I'm just a market reader and on a tape reader, and that's what the tape at this point is saying to me here. So I think it's insane. Now, does that mean the stock market has to go down because of that? I mean, rates have been going up now for quite a while. Let me look at my chart just to make it semi-accurate. But rates bottomed at the very beginning of the year. So essentially, rates have been going up since the beginning of the year, and the stock market is on highs. So I don't know that it necessarily matters. If you have all this liquidity and assets are being bought, then stock market is one asset that's being bought. I don't know that it means the market has to go down. I think at some point, clearly, if they don't get things under control and they have to raise rates, and there's going to have to be a shift in psychology as we inch towards that, which we have started to do. We've inched from there's going to be 6 rate cuts this year to there's going to be 3 and now maybe 2, right? So we're inching towards it, and it hasn't hurt the stock market yet. If we're inching towards they're actually going to raise next, let's see how the market reacts to that over time. But, I don't necessarily think it has to be bearish, but you would argue that it probably would be at some point.
Jason, we love bold perspectives on this show. So I'm appreciative of you for being willing to state one. And I just want to recap a little bit to lead into my next question, what you've just said. You have cited examples anecdotally of strength in consumer spending. You pointed that there's been an appreciation, not just in global equity prices, but in commodities. And you've just said there is a possibility the market could withstand, could maybe a rate hike, or at least get used to the idea that there's going to be a more hawkish Fed for longer. So what does it take, Jason? What is going to be the catalyst for markets to start heading south?
I would say the first thing that has to happen is what you just asked me has to stop being the first question that everybody wants to know. That's all I hear from everybody all day, every day. When's the market going to top? When's the market going to top? And I keep saying not until you stop. Not until you stop wondering when it's going to top. That's when, right? That's what I think. Why will it top? Because it will just get to the point where all the money is in. People have to start believing. They have to start believing. And clearly from last year at this time, when everybody believed there was going to be a recession guaranteed, right? They've gone from believing that there was a guaranteed recession coming to believing that there's not anymore. That was the first step. Now let's get them to believe this story, and maybe some do, but not everyone does. Let's get them to believe this story that nothing matters because NVIDIA and AI is going to save the world, right? So there's never going to be any problem again because the productivity is going to be so amazing, and therefore there's not going to be inflation and all this stuff. Let's get them to believe that. And at that point, when there's just no reason to sell the stock market, that's when it will top, right? But I don't see that right now. Clearly, it's not where we were last year, but it's not where it could get to either. So let's see that. Let's hear that. And we're starting to hear it a little bit. I start to hear it now on TV where people are coming on. There's not very many bears out there. But they're not bears, but they are buying, like I say, laggards, because they're still scared, right? So let's let everybody get super aggressive. Let's let everyone come to the conclusion that the world has completely changed and there's no way anything can go down. And then we can start thinking about, taking the other side.
Jason Shapiro, founder of crowdedmarketreport.com. Thank you so much for joining. Please come back. Want to hear how you think this continues to evolve, whether we see that liquidity continuing to come into the markets. That's it, folks. Join us again back here on public.com's Leading Indicator.
Thanks.